In this video, I'm going to talk to you about why you almost never want to own real estate through an S corporation. S corps are great tax planning tools. We use these all the time when we're talking about owning and operating active businesses, or in some cases even passive businesses. However, you almost never want to own real estate through an S corporation. There are a few exceptions. For example, if you're a flipper and someone who is buying and selling properties by fixing them up and flipping them pretty quickly, that is not really what I'm talking about in this video. I would consider that and carve that out as a separate fact pattern. Here, I'm really talking about a situation where you are owning and operating or investing in real estate. So any type of real estate, from commercial to industrial to single family residences or apartment buildings, it doesn't really matter what type of property we're talking about. If you're investing or owning and operating real estate, you are almost never going to want to use an S corp. So if you're someone who is advised to use an S corporation, or if you already have an S corp for some reason that owns your real estate, I would highly consider you getting a second opinion on that, because I have never in practice seen a situation where owning real estate through an S corporation made sense. The other carve out I want to make sure I mention is that sometimes when you invest in real estate, you also operate a property management company. That property management company might want to be an S corp because that's really a business, and that property management company should not be the entity that owns the real estate. So typically, if you have that type of fact pattern where you're owning real estate but you're also providing property management services, you would typically have that segregated into separate vehicles, and the real estate itself would be in its separate structure. We would not want to have that real estate and that structure be an S corp anywhere, but the property management company, which should be separately owned by you, that can be an S corp, in a lot of cases might be beneficial. So other than that, if you're someone who is really investing in operating real estate, then you're not going to want to use an S corp. In this video, I'm going to walk you through all the different reasons of why we don't like S corps for real estate, and also show you some examples of how this can go wrong. So let's start with one of the biggest considerations here, and that is that the S corp tax planning that we do, and the whole reason we use S corps, is not relevant in this case. So if you're someone who is passively investing in real estate and you're not an active real estate professional, then you don't have to worry about self-employment tax. So S corps are typically vehicles that we use to eliminate or reduce self-employment taxes, and that is really their sole purpose in most cases. There are some cases where I use S corps for SaaS companies for different tax planning than just payroll taxes. But other than that, use an S corp to reduce your payroll or self-employment taxes. And if you're investing in real estate and you're passively investing in that real estate and it's not an active trade or business, you don't have self-employment tax. So just a really basic example here so you can see how this would work in practice is, let's say Mary owns a single family residence in Florida. She just owns one unit, so she's not engaged in any kind of business around real estate. She just passively owns an investment property in Florida. Let's say that property has net income of $10,000 a year. Mary is only going to pay income tax on that $10,000. She doesn't have any self-employment tax there. So adding an S corp or owning that Florida rental unit through an S corp would save no taxes at all. It would actually add additional, probably, compliance fees that you have to pay your CPA to file an extra tax return. So in this case, an S corp would not provide any additional benefits. So it's important you understand that the whole point of why we use S corps and what we're trying to achieve there is not relevant in real estate when we're just investing in it. The next reason, and this is a really, really big one, is that you as a shareholder of an S corp do not get basis for debt. So S corps are not going to get basis for when you have a mortgage on the property. And that is very, very important with real estate, because one of the biggest reasons why real estate is a great investment to make is your access to and ability to use leverage to buy those real estate assets. So this is not the case for other structures. So if you own real estate through an LLC that is not an S corp, which, if you're a single owner of a rental unit and you're just going to own 100% of it, you're going to want to own that through an LLC that you do not check or elect to be an S corporation. Or if you jointly own the property with other people, then that's going to be a partnership. So you would own this through an LLC that's not an S corp or a partnership, and you would get basis in those cases if you set that up right. So let's say Mary didn't listen to this video and she actually owned her, bought a property with an S corp. Let's say that property was worth $500,000. So again, a very common fact pattern is that on a $500,000 property, we might put down as little as $100,000 on that. So we might only have $100,000 of equity on that property. And then Mary takes out a mortgage for the other $400,000 to help her buy that property. Even if Mary personally guarantees that mortgage, which is always going to be the case, the bank is going to make you personally guarantee that, then that doesn't really change the facts here. So let's say Mary did a cost seg study where she was able to get a bunch of bonus depreciation this year, and she actually has a big tax loss this year of $150,000 when you add in that bonus depreciation. Well, because of what we call the at-risk rules that limit our ability to take losses to the amount of money we have at risk in that investment, Mary is only going to be allowed to deduct $100,000 of that $150,000 loss. So she's actually limited to the amount she has at risk, and that's her equity in the property, which in this fact pattern is $100,000. If Mary had used a different structure, she could have gotten basis in the debt for the mortgage, and she would have been able to claim up to $500,000 because that's how much she was viewed as having at risk. But because Mary set this up wrong and she used an S corp, she's only able to claim $100,000 in the current year. The other $50,000 she can't claim, just rolls over to the future, but you're not going to get, some of the great tax benefits of investing in real estate by having your losses limited. And so this is really important to understand before you ever think about setting up an S corp for real estate. Also, there's an issue with S corporations if you make a distribution of appreciated property. So we like to have flexibility in a lot of cases for planning. So let's say Mary owns, property through an S corp and she paid $100,000 for that property, but now it's worth $200,000. So she has property that is doubled in value. It's appreciated. And let's say she wants to gift that property to her sister. She's decided, I've got so much money, I don't need it. Let me gift that property. Well, if Mary tries to distribute that property out of the S corporation, that's going to trigger her recognizing the appreciation, and she's going to pay tax on that. So in this fact pattern, Mary has a taxable gain of $100,000 and she can't avoid triggering that gain. So if she wants to distribute that property out of her S corp to gift to her sister, then she can't do that without having to recognize the taxable gain. So this limits our flexibility with, being able to distribute property out. Maybe we want to put it in a different entity, or we want to gift it, or we want to do something else with it. This is really going to limit our flexibility by not being able to make distributions out of the S corp. This is another big one that is a big problem with S corps and when you own real estate through S corps, is that you do not get step up in basis upon death in the assets held by the S corp. So let's say that I own property through an S corp, so Mary still owns her property. She, again, paid $100,000 for that property, and now it's worth $200,000. So, Mary's, again, the value of the property is doubled, and Mary passes away, unfortunately, and so the property is going to pass down to her heirs. So let's say, the property passes down to Mary's daughter, Sally, and Sally's the sole heir. And as typical, when you inherit something, you might want to turn around and sell it. So while Mary was happy to operate, that investment property and manage that, Sally probably doesn't want to do that, right? Like she might not have time to do that, and she'd like to just sell the asset and take advantage of, recognizing the gain and the value of that asset today. Well, normally, if you set this up right, when Sally inherits that property, she gets a step up in basis to fair market value on the date of death. So if you had not used an S corp, Sally's basis in that property would be $200,000 because that's the fair market value of that property on the day that Mary died and it passed down through her estate. In that fact pattern, Sally could just turn around and sell the property and recognize no taxable gain. So she gets $200,000 in her pocket, no tax because her basis is $200,000, so her gain is zero. However, the problem is that Mary owned that property through an S corp, so Sally doesn't get a step up in basis in the property. So if Sally turns around and sells that property, she actually has to pay tax on a $100,000 gain because she did not get to step up her basis for tax purposes in that property to the fair market value. So this is really bad from an estate planning perspective. I know we never plan to die, but mistakes always happen. And if you're really using, my tax planning strategies that I talk about to their fullest, like with the buy, borrow, die strategy, for example, then you're not going to want to have a situation where your heirs can't get the step up in basis because that defeats one of the big objectives of that planning. So you never want to own, property that you're going to pass down through your estate in an S corp. Last, I just want to touch on that there's some other lack of flexibility around owning real estate through S Corps. So let's say you're someone, and this again is very common, that you might want to take on outside investors. You've invested in a lot of real estate. It's been very successful. And now you want to increase your funds and your ability to go out and buy more properties. You are going to have a lot of limited flexibility and the ability to do that if you do this through an S Corp. So this is why if you invest in real estate funds or syndications, they are absolutely never S Corps. They are always partnerships, and you're investing as a limited partner in that partnership. So you should take that as another reason, just use that as an example in practice. If S Corps actually worked for real estate, people would use them, but they don't. So if you're wanting to take on outside investors, S Corps have a lot of limitations in the types of shareholders that you can have. You can't have anyone who's not a U.S. resident or citizen. So no foreign shareholders. You're limited to only 100 shareholders, and you can only issue one class of stock. So if you wanted to give, preference to distributions to certain individuals that invest, for example, you can't do that. You're all kind of in the same bucket there with S Corps. Also, as I mentioned, distributions out of an S Corp are difficult to do without triggering tax. The same applies to contributions into an S Corp. If you don't own 80% of that S Corp after you contribute property in, you're going to trigger gain. So if I take appreciated property and I want to contribute that into an S Corp that I'm going to, jointly own with other people, if I don't own more than 80% of that S Corp that I contribute the property in, I trigger and pay tax on the gain when I contribute that in. So there's a lot of, issues with around flexibility in using S Corps as far as when you're trying to invest with other people. So this was a good overview of all the different reasons of why we don't use S Corps when we're investing in real estate. As I mentioned before, if you are someone who invests in real estate and you want to know what is the right structure to use, if you're going to be the sole owner, you want to use an LLC for each property that you own, and you don't want to make the tax election to treat that as an S Corp. So just keep your LLC as is. It's going to be a single member LLC that just is owned 100% by you. If you're investing with a spouse or, someone else that's going to own part of the properties or properties with you, you would use a partnership structure. And again, you would just set up your LLCs, own that jointly with someone else, and not make any tax election. So you wouldn't make the S Corporation tax election, and you certainly wouldn't make the C Corp tax election. So the good news is you don't have to file any elections, but just again, if you're thinking about or have, invested in real estate and own real estate assets through an S Corp, I highly recommend that you reassess if that's the right structure, because there can be a lot of disadvantages to owning that property through an S Corporation. So hopefully you found this video helpful. If you did, please like the video and subscribe to our channel.